Let's go.
Welcome, everyone, to Zephyr's Adjusted for Risk podcast from the shores of Lake Tahoe. This is Ryan Nauman, the market strategist here at Zephyr. One of the hottest trends and topics in the investment management space has been the explosive growth in ETFs, particularly active ETFs. Well, I have on one of the brightest and most respected voices in the ETF space with me today to talk about trends in ETFs and so much more. But before we get started, this episode is sponsored by the award-winning Zephyr, which helps investment professionals make more informed investment decisions. All right, enough from me. Let's get on to the show and the star of the show. I'd like to welcome Aniket Ullal. Aniket is the Senior Vice President and Head of ETF Research and Analytics at CFRA Research. Aniket, thank you so much for coming on the show. It's such an honor to have you on to talk about a space that has just captured so many headlines. Can you please tell us about a little bit more about yourself and CFRA Research?
Sure, Ryan. Thanks for having me on, and excited to be here. And thank you for that kind introduction. A little bit about CFRA. We're one of the world's largest independent investment research firms. By independent, what I mean is we don't manage money. We're not affiliated with an asset manager. So it really allows us to take kind of an independent view of what's happening in the equity and investment and fund space. Our roots are in forensic equity research, but over the years we've expanded to include all types of research. So we have fundamental research, a business that we bought from S&P. We have technical research, policy research, and of course in the ETF space we have ETF data and research. And I head up the ETF research function. I actually joined CFRA in 2019 when CFRA acquired an ETF data business that I had started. And before that, I used to be the product lead for S&P's US equity indices. So been in the indexing and ETF space for a long time, and so excited to discuss that with you.
Fantastic. So you have some great insight and experience in the evolution of ETFs. Real quickly, with CFRA too, the primary user of your research, is it financial advisors, other institutions? Not so much, or is it the retail investor also?
It's not so much the retail investor, although a lot of retail investors will see our content through our brokerage partners. We have two segments. One is on the institutional side. We have hedge funds, large asset managers who tend to take our forensic and policy research, and on the wealth side, they tend to take more of our fundamental equity and fund research. So we distribute that through almost all of the big brokerage platforms, wealth managers, RIAs. So we touch both segments.
Fantastic. I read, as a single person, at Zephyr that does research. I read a lot of your research at CFRA. You guys have a lot of great content, a lot of great analysts, so doing some really great things out there. You know, ETF space, it's evolved. When I started, it was just the basic vanilla ETF Spider, COO, iShares, and that's it. Innovation in this space has just really taken off. And it's really probably going to expand even more with the role of AI tools and, the innovation in the ETF space, it's taken off so much. What does this mean for financial advisors as they build investment portfolios for their clients?
I think you said it, provided a good context, which is started. So I really think of innovation, the ETF space, in three waves. And the first wave was really the core indexing wave, which is what you just alluded to, right? Like initially, just ETFs tied to the big headline indices, the S&P 500, Russell 2000, the MSCI international indices, right? So that was kind of the first wave, and obviously that allowed financial advisors, particularly RIAs, to create portfolios with these low cost, transparent building blocks and use those products in their portfolios. The second wave was really the smart beta and thematic wave, and I think that's when indexers started asking questions of, can we go beyond market cap weighted indices, right? Can we weight based on revenue? Can we weight based on fundamental factors? And I think the interest in low volatility as a factor was one of the key drivers of growth in the kind of smart beta and thematic wave. And now I think we're in the third wave, which is active and alternatives. So we've seen a lot of growth in active ETFs, as you mentioned, kind of at the top, both in equity and fixed income, and alternatives too, right? Like we've seen hedge fund replication, of course, crypto. So I will say a couple of things about active, which is there's a couple of misconceptions. One is a lot of people think that because there's been growth in active ETFs, it kind of implies there's been a decline in indexed core indexing. I don't think that's the case. Actually, what we'll see in our data is active has really taken share from smart beta. So
Okay.
the third wave is kind of grown at the expense of the second wave. The first wave, which is the core low cost indexing, is just growing, and Vanguard is a good example of that. So that's kind of one misconception in the about the active space. The second is this is not the traditional active of stock picking. Like we're seeing a lot of systematic active, rules based active, things also options based strategies, all of which tend to get clubbed into active, but there's a lot more under the hood than just your traditional stock picking active. So there's some nuances there, but that's kind of how I see the growth in the industry and how we've seen the different waves of innovation.
Yeah. Aniket, that is such a fantastic way of just talking about the past, 20, 30 years and the evolution of ETFs. You did it very quickly too. And so it was awesome. You know, it's interesting that you said the active ETFs are really kind of taking market share from smart beta. Is that because, you have the smart beta and like you said, that really kind of was the baseline for active and, people are like, okay, smart beta is great, but active ETFs take it a step further in that innovation. Is that maybe why you're seeing some of that shift in the active from smart beta?
I would say, in a sense, they were solving the same problem, which is as an investor, I want to get access to certain investment factors, right? This could be, let's say, value, growth, your free cash flow, dividend, low vol. This much,
Yeah.
as you know, the pharma French three-factor model is expanded now to many more factors. You guys know this very well. Now you can provide access to that through an indexed structure, right, where you just track an index, or you can have systematic active where you're not technically tracking an index, but you're still using all these factors to construct portfolios. So from an investor's perspective, I think it was solving the same problem, but there's a lot of financial advisors who believed in certain managers who were active. I think dimensional funds is a good example of this,
Yeah.
where a lot of financial advisors love dimensional funds, but their funds were in traditional mutual funds. Once they came to the ETF space, some of them through mutual fund to ETF conversions, that resulted in a lot of adoption. So I think the reason active grew at the expense of smart beta is because solve the same problem. Whereas
Yeah.
if you look at core indexing, right, that's solving a different problem. That's just saying I want to be in the S&P 500 at 3 basis points, and active is not going to replace that as easily.
Yeah. Yeah, I agree. I think there's always going to be a lot of investors out there that, don't believe that you can, get consistent alpha and outperformance. So just, track an index and for majority, a lot of people that works. And that's why, it's so popular. You talked, and I'm really glad you brought up active ETFs and kind of the misconception there. It's not like just bunch of picking. There's still a lot of rules-based, technology-based active ETFs out there. My question for you now is, are we kind of getting out of control with some of these crazy innovation in ETFs? We have options-based, defined outcome or, the buffered ETFs. We've got leverage products, single stock ETFs. You could just go on and on. I think there might be a meme out there, Aniket, that says there's an ETF for that. Um, can you comment on the rise of these complex products? Are we going a little bit too far with them, you think?
I think there's always a healthy tension in any growing industry between, giving consumers more choice, or in this case, investors more choice, and kind of too much product proliferation. And I think the industry is kind of grappling with that, and I think regulators are also grappling
Yeah.
with that. We tend to lean on the side of investors having more options. I think ultimately we should trust investors to make the right decisions for themselves. But having said that, obviously we want the SEC to have certain guardrails and also accompany all of those products with relevant research tools. And that's the reason a firm like yours obviously is successful, and the reason we exist as an independent research firm, right? So, but if you look at the different products that you mentioned, they all have slightly different um, kind of aspects to them. The one common theme I would say to innovation in the last year is use of derivatives. I think that's really what's made these products more complex, but they all use in slightly different ways. So, for example, if you look at covered call strategies, right? This is call writing on top of
Yep.
owning a bunch of stocks. That's primarily serving an income generation need. And I think that's been very valuable to, they're probably a little less complex and probably valuable to investors. If you look at defined outcome, again, it's serving a need. This is where investors can trade off, some of their upside participation in exchange for some downside protection.
Hmm.
And yes, these are a little bit more complex, but again, I can see why there's value there. There's been a lot of debate recently in the industry about the value of buffer and defined outcome
Yeah.
ETFs, but I can see why it's appealing to investors. Once you get into the single stock leverage space, now we're really getting into kind of the speculative space, right? Like, do we really need a 3x GameStop
Yeah.
ETF? I'm not so sure. Maybe for some people who are doing short-term trades, but probably not the average investor. So it really depends on which product we're looking at or which product category we're looking at. But in general, I think it's very important now for investors to be more aware, be informed, do their research when looking at these products.
Yeah. And again, I cannot agree with you more about providing more products to the investor, can only help them in achieving their goal. But with that being said, it puts more on the financial advisor, that middle person, to really understand the products and also educate the retail investor. Because I know if I was a financial advisor, the last thing I would want to do is have that conversation about I put your money in a product that really wasn't right for you and it blew up, right?
Right.
Why? So I agree with you. Can you have thought, give some tips to financial advisors and, having that conversation, providing education and, for some of these very complex products?
I would say understanding the structure is very important. So, for example, if you take just taking defined outcome as an example,
Yeah.
this is sometimes called buffer ETFs. I'm using these two terms synonymously. But a typical buffer ETF is launched as part of a series, and we've typically seen these series be monthly series. So, let's say, for example, if the buffer ETF launches in January, when it launches, it's designed to reset every in that same month every calendar year.
Yeah.
So at the beginning, when it's launched, it has a particular upside cap percentage and a certain downside protection percentage. Now, if you buy that ETF in January and hold it for an entire year, yes, you're going to be subject to that cap and downside protection. But if you get in 3 months later, the market has moved. So the remaining cap may have changed, the remaining downside protection may have changed. And so investors need to really, and advisors really need to look at, okay, what it says on the prospectus or on the kind of the tin may not be exactly what's happening when I get in 3 months later. So that's an example of paying attention to how does the product actually work in practice. That doesn't mean the product is badly designed. It just means that more due diligence is required. Same for active ETFs. I think being able to look at the holdings of an ETF.
Yeah.
And that's something at CFRA we really emphasize because we do a lot of fundamental equity research and our stock research kind of feeds into our overall ETF rating. So we really focus a lot on looking at holdings. And so, doing that kind of due diligence, looking at these kind of nuances is really important.
You brought up a great point. At Zephyr, we focus really on the investment analytics, the returns based, style analysis, and that tells a good part of the story. And it worked really well, and it still works well today, but worked really well for your vanilla based strategies where you know what the strategy was, you know what they held, and you're just kind of working out where am I going to get the best risk adjusted returns over the long period and how do they play with the other portfolio holdings of a portfolio. Fantastic. But with these complex, ETFs, you really got to do your due diligence, know what's in them, how they work. And you did a great job explaining the importance of that, because it now works all together, and it just adds more to the plate of the financial advisor.
Absolutely. Yeah, I agree with you.
Another big topic, and it's one of those topics where I know a little bit about, not enough, and that is ETFs as a share class. I hear it all the time. We were at Exchange. It was a big topic there.
Right,
Um,
right.
let's just start at the top. What does it mean, ETF as a share class?
And this is a whole can of worms. It's a fairly complex topic, but most simplistically, what it means is that if somebody is managing an existing, if an asset manager is managing an existing mutual fund, if this gets approved, they would be allowed to issue a share class of a traditional mutual fund that trades on an exchange. So, in other words, you would have an exchange traded share class of an existing mutual fund. So, you would have one share class, which is a traditional mutual fund, and another share class that is an ETF. Now, if you actually look from a legal perspective, an ETF is essentially a mutual fund, right? It's basically a 1940 Act product. It's an open-ended fund. From a regulatory perspective, it's actually not. It's actually the same, kind of, or similar. Rather, there's some things it's not subject to, which is why ETF issuers had to get an exemption from mutual fund rules.
Okay.
But they're very similar. From an investor's perspective, there's actually a lot of differences because ETFs trade on an exchange, so they're priced intraday, unlike an ETF, unlike a mutual fund, which is priced, the NAV is struck once a day. Obviously, there's much more transparency, typically disclose their holdings every day, although there are some exceptions. There's tax efficiency because of the creation redemption process. So from an investor's perspective, an ETF is an attractive option and in some way superior to a traditional mutual fund. So that's kind of the basic concept. And what's really driving this is the fact that all the growth has been in ETFs in the last 10 years, right? We've had consistently for 10 years significant flows into ETFs. And if you strip out money market funds, we've had significant outflows from mutual funds. And so that's obviously driving mutual fund managers to say, can I offer my product in a format that's more appealing to investors? So that's really what's kind of high level driving what's happening.
Perfect example or explanation. You mentioned when we had our little pre discussion, Vanguard, right? Vanguard's going through the process, and if they're kind of leading the way, the bellwether of passive investing, they're going through. What does that mean for this space of Vanguard, gets approval to do ETF as a share class, and they're moving all their big mutual funds in the ETFs? What does that mean for financial advisors?
It's actually useful to have provide a little bit of context on this, which is Vanguard actually already had approval for ETFs as a share class. So for many years, Vanguard was the only firm that had ETFs as a share class, but they only had approval in the index space.
Okay.
So they got approval and then they patented that. So for many years, Vanguard was literally had an unfair advantage. You can argue whether that's fair or not, but essentially they were the only firm that could issue ETFs as a share class of mutual funds. So they already had this approval.
Okay.
That patent actually expired in 2023, and since then, 60 asset managers have filed to do the same thing, both for index and active. What Vanguard has recently filed for is doing the same thing in an active format because they had the approval already for in the index form, doing it in index format. Now they've applied to do it in an active format. So if they get approved, it'll probably be along with all of the other 59 or 60 asset managers who've applied. So this has been done before. It just hasn't been done in an active format, and it has been done so far only by Vanguard, not by the others.
Interesting. Interesting. Do you think it's going to be kind of an easy process? Do you think it's one that's going to be approved here shortly? Something that is going to be commonplace across the asset management space?
So what I find interesting about ETFs as a share class is if you look at the entire ETF ecosystem, you've got the asset managers on one side and you've got the investors, and then you've got the intermediary sitting in the middle. I think if you look at cost benefits, it's good for the asset managers, it's great for investors. it's going to be most challenging for everyone who sits in the middle. So that's the intermediaries, the broker dealers, the custodians, everyone who has to actually implement this. From an asset manager's perspective, there are advantages to having ETFs as a share class, right? Because I can port over my existing mutual fund performance and use that for my ETF share class. It gives me scale because I may have existing assets in my mutual fund, and it allows me to leapfrog up kind of the ETF leaderboard, asset leaderboard. So from a asset manager's perspective, the advantages are clear. From an investor's perspective, also there are advantages because I can now, let's say I am an investor who likes a particular mutual fund manager. I can now access that same strategy in an ETF format, which is more transparent, more liquid, more tax efficient. So the biggest challenge I think is going to be for the intermediaries, particularly the broker dealers, because they need to adhere to certain regulations, particularly Reg BI, right?
Yeah.
Now, if I'm a broker dealer who's been offering a mutual fund and suddenly I'm offering an ETF share class, Reg BI considerations kick in because Reg BI has certain, requirements like the care obligation, where you got to make sure that what you're offering to an investor is the best possible option and you've looked at everything. And when you offer two share classes of the same fund, that complicates all of this. So there's also implementation issues. Let's say you've got an investor who's already invested in a mutual fund.
Yeah.
They want to do a tax efficient or tax free transfer to the ETF format. How will that happen? How will that be enabled? All of these are unanswered questions.
Yeah.
So I think it's really the firms that sit in the middle that are going to face the most challenges. I think they're on board and they're
Yeah.
supportive of it, but I think they recognize that it's not going to be easy, and they also have technological changes to make to actually make it happen.
And it kind of feels as if it's kind of how it always is. That middle person's always the one that's got most of the work and uncertainty. It's always, the provider of the
Right.
new product or service is always good, and the recipient. And it's
Right.
that middle
Exactly.
person that's got to try and figure out how to make it all work. But I'm a firm believer if it helps the investor, it helps them achieve their goals and, aligns with their investment objectives, it's best for all parties. So hopefully they can make
Yeah,
that work.
that's a great point. If there's a lot of investor demand for ETFs as a share class, eventually the intermediaries are going to figure out a way to do it, right? And they're going to invest in it.
Yeah, and exactly, especially for the asset managers too, and those broker dealers, right? They don't want to lose business, so they're going to have
Right.
to do it and try to figure out the best way of doing it. But I think it will be good for everyone because I'm a firm believer in ETFs, especially now that we have active ETFs. I'm more of and like you said, there's a misconception there in active ETFs, but you know, um, so I like it, and I like that we can get it to those other investors out there. So let's talk more about, you mentioned flows, where the
Right.
money's going, and let's talk about the investment space. We've seen finally U.S. supremacy is kind of pulled back a little bit. International trade, international equities have really outperformed by quite a wide margin this year to date. What do the ETF flows tell us about that US versus international trade? Are they kind of showing the same thing that, people are flocking to the foreign equities?
So it's interesting. Firstly, flows this year have been really strong. We've through the last couple of days, we've had $500 billion in flows in US ETFs year to date, right? If you look at the same period last year, we were at about 328, like 330 billion. And last year was a record year for ETF flows, right? We had 1.2 trillion for the entire year, which means we're on pace to beat last year's record, which is already very significant. So that's kind of the broad context of how flows look. The key difference, like you said, is what's driving those flows. Last year, flows were very driven by the AI trade, were driven by US exceptionalism. We had a very strong dollar. So the macro backdrop and the fundamental backdrop was very different. This year, what's interesting is that you're right that international has outperformed the US. And of course, in the US, we've seen a kind of a bounce back since April 8th when the
Yep.
reciprocal tariffs were paused. But um, the flows actually haven't reflected that. Investors have been very resilient and, in fact, have bought the dip a lot this year. So we've actually seen very healthy flows, even into US equity ETFs, despite some fairly significant downturns. And if you look, and we think this is driven a lot by retail investors because the biggest beneficiary of these flows has been Vanguard, which tends to have much more of a retail footprint. So it could be BOO, VTI, VO, some of these big Vanguard equity tracking ETFs. They've actually had significant, in fact, Vanguard itself accounts for over a third of all flows in the US this year.
Wow.
So, which really tells us the retail investor stayed invested and has been resilient even through these downturns. So that's kind of where we are now. Could that change? Yes. Having said that, international is attractive from a valuation perspective because we
Yep.
saw this huge run up in the US. The challenge with international, particularly in Europe, is they just don't have that big tech engine that the US has.
Yeah.
So if you look at most European, developed Europe ETFs, they're very dominated by financials, they're very dominated by industrials, right? You don't have the Apples, you don't have the Alphabet, you don't have the Metas.
Mhm.
And so it becomes more of a complement to an US portfolio. Because as you know, US, portfolios are very tech dominated, right? But even if it's the S&P 500, even after Google and Meta were taken out of tech still makes up like the biggest percentage of. So I would say yes, there is interest in international, with the two caveats that investors haven't given up on the US. They've actually been fairly patient, and also recognizing that international doesn't have that tech, particularly in Europe. In Asia, of course, you've got China internet and Indian internet stocks and tech stocks, but in Europe, it's been more financials and industrial driven. So it's going to be interesting to see how that evolves. I do think investors will kind of allocate a little bit more towards international,
Okay.
but you can't not be invested in the US given just all the innovation with AI.
Yeah, you bring up a very good point. When the tariffs were announced and, President Trump was elected, my first thought was, oh my God, this is going to hurt international foreign equities because of tariffs and everything. I was completely wrong. And do you think a lot, because you brought up financials, you know, the international is made up, a higher weight of financials. They're a little bit more isolated from tariffs. They're not as sensitive to tariffs. Do you think that's one benefit in the valuations, of course? Do you think that's another driver to the outperformance there?
I think another key driver is domestic stimulus. The one of the engines of Europe is of course Germany. Germany's done a lot. I think they've realized that they need to pick up the slack where the US has pulled back a little bit. Like defense, for example, the defense sector in Germany has actually done really well. Germany announced a $500 billion infrastructure fund to kind of stimulate the economy. They've also removed some of the caps on the debt limits. And so, it really that's driven. So it's a combination of the fact that, like you said, financials is more domestic oriented and stimulus is helping the industrial sector.
Yeah, interesting. Let's talk more about flows. It was interesting you said, it's still very resilient in the US, a lot of flows still there. So, do flows, do you think, track performance, right? What's the correlation there between flows and performance?
It's complicated, but in general we've seen flows lag performance. I would say as a general rule, we tend to see, and there's a reason for this. Partly because, particularly, I'm focusing now more on the ETF space and what we see there. And the reason I say that is because if you look at what's driving flows now, a lot of flows in the ETF space have been driven by model portfolios, right? So BlackRock and all these people who provide model portfolios. These model portfolios don't rebalance every day, right? They may rebalance once a month, once a quarter, and so on. So they tend to move more slowly than performance, which by definition is moving intraday and every day. So it's not uncommon for us to see flows lag performance. Now, there are segments where the reverse happens, but in general, performance tends to be faster moving and faster reacting to events than flows.
Hmm. Fantastic. Great insight. Great thoughts there because a lot of people do track flows, right? So it's
It's
very
still it's still very
interesting.
important. Yeah, I mean, flows are
Yeah.
certainly very important, particularly if you take longer time periods of time
Okay.
and look at certain categories. But yeah, it is important to realize that flows are going to, particularly as model portfolios become more important, they could lag performance.
Yeah, interesting. All right, Aniket, let's put your crystal ball on, bring your crystal ball out. I cannot believe that we're halfway through 2025 already. It just blows my mind. But what do you think are the biggest ETF trends for the remainder of 2025?
I would say for an ETF investor or an ETF asset manager, I would look at two things. One is I would look at the macro, and then I'd look at micro from a regulatory perspective.
Oh, okay.
From a macro perspective, I mean, it's pretty clear we've got some big things that are going to emerge in the next few weeks. One is, of course, we had the pause on reciprocal tariffs that expires July 9th.
Yeah.
That's an important event that's coming up. And of course, now we've got a much more ramped up conflict and extended conflict, much more than we originally anticipated between Israel and Iran. That's another kind of uncertain item that's out there. How much does the US get involved? So I would say over the last couple of weeks, we've seen many more macro issues come up. We've also got a much weaker dollar, right, than we had last
Yeah.
year. So from a macro perspective, I'd be watching tariffs, I'd be watching the geopolitical conflicts and the dollar. None of this is rocket science. I think most investors recognize that these are important issues, but the fact is that these will drive investor outcomes this year. From a regulatory perspective, I think that's more important for
Okay.
industry participants like asset managers. So, for example, the SEC we know is much more permissive now than Gensler's SEC. So they may be more open to ETFs as a share class, various types of crypto ETFs, and so on. So these are some of the issues I'd be watching.
Interesting. I love it. Love it that you brought up the macro and micro side. Fantastic. Such a great conversation, Aniket. We covered a lot. I feel as if we could have done like probably three different episodes here on each little piece that you talked about. We could dive in so much more, but great stuff, great insight. I love that. Thank you so much for coming on the show and sharing that insight. Is really a lot of fun and an honor to have you on. Where can our audience get more information about CFRA research?
So our website is cfreresearch.com. That's probably the best place to start. We have a platform for advisors called MarketScope Advisor. You can go to advisor.marketscope.com as well. So both of those are good places to start.
Fantastic, Aniket. Thank you. And thank you, everyone, for listening to this episode of Zephyr's Adjusted for Risk podcast. You can watch all of our other episodes on the Zephyr YouTube channel and Spotify. Also, please be sure to subscribe and like those YouTube and Spotify channels and follow us on LinkedIn. Thank you and have a great rest of your week.